Are we heading towards a global economic downturn? In today's episode, industry experts dissect the alarming rise in global unemployment and the mixed impacts of aging populations on inflation. Get enlightening insights from seasoned money manager Jason Shapiro, who shares his 6-month portfolio review, and economic analysts Eric Basmajian and Brian, who debate the future of inflation. Uncover the critical role of central banking policies and stay ahead of the market trends. Don't miss out. Like, subscribe, and stay informed. Today, on Financial Analysis in Review, we will summarize the following videos. From Crowded Market Report by Jason Shapiro, we have insights from a professional money manager, 6-month portfolio review. From EPB Research, we have Does an Aging Population Cause Inflation or Deflation? From Eurodollar University, we have Global Unemployment is Rising. What does this lead to? On today's episode of Crowded Market Report, host Jason Shapiro takes us through a detailed 6-month review of his portfolio's performance in 2024. Jason, a seasoned professional money manager, offers insightful analysis on returns, risk, and correlation strategies, sharing his methodology and experiences. As he dives into the data, he brings forth both the art and science of portfolio management, ensuring his strategy aligns with his and his client's board expectation. The central thesis of this video is a comprehensive review of Jason Shapiro's portfolio, designed to achieve positive returns with minimal drawdowns and maintain zero to negative correlation with other market return streams. The half-year review aims to verify if the portfolio's performance aligns with these objectives, making adjustments as needed to sustain long-term effectiveness. Here are the key points discussed by Jason Shapiro performance metrics. The portfolio's return of approximately 11% for the first half of 2024, closely reaching the annualized target of 12 to 15%. Max drawdown remained under 3%, aligning perfectly with the risk management goal of keeping it below 5% annually. Correlation to other return streams was slightly negative, ensuring the portfolio's unique value proposition of providing non-correlated returns remains intact. Trade statistics. Historically, Shapiro's winning trades hovered around 38%, but this year and the previous one saw a higher winning percentage with slightly lowered returns per trade. The analysis revealed that 73% of the P&L for this period came from a single trade, highlighting the importance of capturing and riding profitable trades. Correlation analysis. The portfolio maintained a slightly negative correlation to a CTA index, predominantly composed of trend-following strategies. During periods where trend-following strategies succeeded, Shapiro's strategy avoided trades, effectively minimizing losses while positioning for gains once trend-following strategies struggled. Process importance. Regular portfolio reviews are critical to ensure strategies remain effective and adapt to any significant changes in market conditions. Continuous monitoring of the balance between winning trade ratios, correlation metrics, and drawdowns contributes to sustaining long-term investment success. Jason Shapiro made the following predictions: future performance expectations. Shapiro expects his portfolio to continue delivering within the target range of 12 to 15% annual returns, with max drawdowns staying below 5%. Maintaining zero to negative correlation with other market strategies remains crucial to ensuring diversified return for his clients. Jason Shapiro concludes this portfolio review, reaffirming the importance of meticulous performance monitoring and adherence to a robust trading process. He encourages regular assessments to ensure alignment with long-term objectives. His calls to action include the significance of a disciplined approach to portfolio management and the need for investors to integrate non-correlated strategies to optimize their return risk profile. For more insights, Jason invites viewers to engage with the Crowded Market Report on Substack. Welcome to EPB Research. Today we delve into a fascinating debate: the impact of an aging population on inflation. Our guest, Eric Basmajian, provides a nuanced analysis enriched by a lively counterpoint from Brian. Each brings a wealth of economic knowledge to the table and offers contrasting views that make for an enlightening conversation. The core debate centers on whether an aging population leads to inflation or deflation. Eric argues that aging populations are generally disinflationary or deflationary, based on reduced aggregate consumption and lower investment levels. Brian, however, posits that the current demographic shifts in the U.S., particularly with millennials entering their peak productivity and family formation phases, could lead to structurally higher inflation in the short term. Here are the key points discussed by Eric Basmajian and Brian Impact of aging populations. Eric underscores that aging populations, such as those in the US, Europe, and Japan, tend to exhibit lower levels of aggregate consumption and investment. He references the baby boomers' transition into retirement as a key factor in decreasing aggregate savings and consumption, traditionally contributing to deflationary pressures. Millennial influence. Brian argues that millennials, who are now in their peak productivity and family formation years, are propelling demand for housing and other goods, hence driving inflation. Despite high mortgage rates, this group shows persistent demand for new homes, a trend that Brian highlights as structurally inflationary. Labor force composition. Eric notes that current labor shortages, which have been partly offset by immigration, contribute to inflationary pressures. He also discusses the shift from high savings rates among baby boomers to potentially lower rates among millennials as an inflationary dynamic. Consumer expenditure survey data from the Bureau of Labor Statistics, BLS, shows that aggregate consumption falls significantly past age 65, adding to Eric's deflationary argument. Brian counters this with theoretical perspectives on how the value of currency and monetary policies might be the real drivers of inflation, rather than demographic shifts. Eric Basmajian and Brian made the following predictions. Short-term inflation. Brian predicts that for the next decade, the U.S. will experience slightly higher and stickier inflation due to the composition of the labor force and persistent demand from millennials. This view is bolstered by observations from the Bank of International Settlements and historical economic dynamics post-Great Financial Crisis, GFC. Long-term deflationary trends. Eric argues that once we move past this decade, the aging population will dominate the economic landscape, resulting in lower aggregate demand and deflationary pressures. He sees the eventual reduction in labor force participation and higher savings rates among older populations as key factors. Eric Basmajian concludes by emphasizing the importance of understanding demographic shifts' complex role in economic outcomes. He advises viewers to consider both short-term inflationary pressures and long-term deflationary trends when making investment and policy decisions. Brian, on the other hand, encourages a more nuanced view that separates real economic factors from monetary phenomena, suggesting that while demographics matter, how central banks manage monetary policy will ultimately dictate inflationary trends. Welcome to Eurodollar University, your go-to channel for deep dives into the world of economics. Today, we're privileged to have Steve Van Meter, a seasoned financial analyst known for his unapologetic takes on global economic trends. The core thesis revolves around the rising unemployment rates worldwide and the questionable effectiveness of central banking policies aimed at mitigating this trend. Van Meter argues that increasing unemployment signifies deep-rooted, globally synchronized economic issues that central banks may not be equipped to resolve effectively. Here are the key points discussed by Steve Van Meter. Global unemployment. Unemployment rates are noticeably rising in major economies, including Canada, Germany, France, Sweden, the UK, Japan, and the United States. Despite central bankers' claims of resilient economies, the data indicates otherwise. Canada's unemployment rate has risen by 1.2 percentage points in just a year. Central banking policy responses. Central bankers suggest the unemployment rise is part of their strategy to normalize the economy post-2021's red-hot economic conditions. Rate cuts by central banks like the Bank of Canada and European Central Bank, ECB, signal their underlying anxiety about the rising unemployment. Van Meter argues that central banking policies lack correlation with key economic variables like consumer prices and GDP. Global factors and economic synchronization. Unemployment increases are globally synchronized, impacting various economies simultaneously. There exists a strong correlation between consumer prices across different economies. Rising unemployment in countries like Sweden, from 7.1% to 8.3%, indicates a global pattern. Steve Van Meter made the following predictions: ineffective rate cuts. Van Meter predicts that rate cuts by central banks will not halt rising unemployment. Historical evidence suggests that rate cuts often accelerate unemployment rather than reduce it. Continued global economic decline. The global economy is expected to continue its downward trajectory as rising unemployment puts further pressure on economic activity. This will likely lead to increased political unrest due to economic dissatisfaction. Increased rate cuts. Central banks, despite their initial plans, will be forced to adopt more aggressive rate-cutting measures sooner than expected. This would be a reaction to the economic pressures and growing unemployment rates globally. Van Meter concludes that rising global unemployment reflects deeper, more systemic economic issues that current central banking policies are ill-equipped to handle. He stresses that the anticipated rate cuts may not suffice in halting this trend, and the global economy might be in for a more protracted and severe downturn. The onus is on policymakers to recognize the synchronization of these global economic trends and enact measures that go beyond short-term rate adjustments. Jason Shapiro's 6-month portfolio review reveals a strong performance with an 11% return and a maximum drawdown under 3%. He emphasizes the need for non-correlated strategies to achieve consistent long-term returns. On the inflation debate, Eric Basmajian and Brian present opposing views. Eric predicts long-term deflation due to aging populations, while Brian expects near-term inflation driven by millennials' demand. Steve Van Meter highlights rising global unemployment and doubts the effectiveness of central banking policies, predicting further economic decline. Stay tuned for more in-depth analysis and expert opinions to navigate these uncertain times. Thanks for watching Financial Analysis in Review for July 1st, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.